Coming to this comprehensive question on retirement, the balance sheet of A, B and C whose share equally as on 1st January 2005 is as follows. So students, it is given that the old partners are A, B and C and they share equally. That means the ratio is 1:1:1. The balance sheet include assets like cash, stock, debtors, land and building, and on liability sides we have creditors and capital accounts. On this date, C retires. That means C is the retiring partner, which makes it very clear that the continuing partners are A and B. Now students, on this date, the assets are to be valued as this. Stock earlier appeared at 50,000 is now to be valued at 20,000. Therefore, a decrease of 30,000 is to be accounted for. Similarly, in land and building, 50,000 increase is there, which is to be accounted for. And for creditors, there is a decrease of 10,000, which should be accounted for. Prepare revaluation account, capital accounts and the balance sheet. The goodwill of the firm is valued at 60,000. That means the share of the retiring partner or the share of the goodwill of the retiring partner is to be based on the goodwill of the firm, which is rupees 60,000. So let us come to the first step, that is to calculate gaining ratio and how to treat about the goodwill of the retiring partner. Coming to the workings first, the old ratio of A, B and C is given to be equal, that is 1:1:1. In this case, C is retiring from the business and nothing is mentioned about new ratio. So this would be your new ratio, that is 1:1. Remember, when nothing is given about new ratio, again this ratio of 1:1 between A and B would be taken to be gaining ratio. That means the gaining ratio among the old partners or the remaining partners A and B is also 1:1. So now students, we have new ratio and we have gaining ratio. So let us come to journal entries for goodwill. The goodwill of the firm is valued at 60,000. The goodwill of the firm is valued at rupees 60,000. C's share, that is the retiring partners, share is 1/3. This implies C's goodwill would be equal to 1/3 of 60,000. That is, remember the goodwill was 60,000. So 60,000 into 1/3, that would be 20,000. So now students, C's share of goodwill is 20,000. This share has to be provided to him by the remaining partners and they will do so in their gaining ratio. So the entry would be A's capital account debited, B's capital account debited, to C's capital account. Again, the concept of entry is very clear, that is the gaining partners are providing goodwill to the retiring partner. C's share is 20,000 and that would be 10,000 and 10,000. Narration being goodwill or share of retiring partner provided in ratio of 1:1, that is gaining ratio. So now students, the entries for goodwill is very clear, that is the remaining partners will pay for the goodwill share of the retiring partner. Remember, you have to draw the format for journal. So the entry is A, B to C, 10,000, 10,000 and to C 20,000. Moving ahead, we will prepare revaluation account wherein we will revalue the assets and liabilities as given in the question. So now students, in this case, the stock was originally valued in the balance sheet at rupees 50,000. But remember, it was very clearly given in the question that it should now be valued at 20,000. That means there is a decrease in the value of stock. So decrease of assets is mentioned on the debit side to stock account, that is 30,000. Then land and building, which appeared in the balance sheet at rupees 2 lakh, was to be revalued at 2,50,000. That means there was an increase. So by land and building account, 50,000. Then by creditors. Why on the credit side? Because creditors were originally valued at 50,000, but their new value was 10,000. That means there was a decrease of 10,000. So whenever there is a decrease in the value of liabilities, the entry is liability to revaluation. So on the credit side of revaluation account, creditors 10,000. Now students, total it out. On the credit side, we have total of 60,000. 60 minus 30. Two partners capital account. 30,000. That is the difference. And remember, this 30,000 would be shared by old partners A, B, and C in their old profit sharing ratio, which is equal. So for A, 10,000 worth of profit, for B 10,000, and for C 10,000. That is in equal ratio. Coming to partners capital account, A's capital account, B's capital account, C's capital account, debit side, credit side. Remember to fill in the format particulars, amount, particulars, and amount. Now students, A's capital as per the last balance sheet was 1,50,000. For B it was 1,40,000, and for C it was 60,000. So they are credit balances. They are mentioned as by balance brought down for A, B, and C respectively. Now students, the first entry that we did was for goodwill. The entry was A, B to C. So in that entry, A was debited to C's capital account, that is 10,000. To C's capital account, the amount is 10,000. But in that journal entry, C was being credited. So on the credit side of C, by A's capital account, 10,000, and by B's capital account, 10,000. Okay students, so what we have done is we have posted the journal entry regarding goodwill. Now coming to the next step, that is revaluation account. We had prepared the revaluation account, and in that revaluation account, each partner should be credited with a profit of 10,000 rupees, right? You can go back to revaluation account and check that there was a total profit of 30,000, which should be credited to each partner's capital account. So by revaluation, 10,000, by revaluation 10,000, and again by revaluation 10,000, that is profit on revaluation. Now students, there is nothing more to be posted into these accounts, so let us find their balances. For A, it is 1,60,000 total on the credit side, subtract 10,000, the balance carried down would be 1,50,000. Similarly for B, it is 1,50,000 total minus 10,000 to balance carried down, which is 1,40,000. Coming to C's capital account, students, totaling on the credit side gives us an amount of 90,000. But remember students, C is going to retire from the business, so he will no longer be a partner. Hence, no balance should be carried in his capital account. That means capital account would now be closed. So any balance that is there should either be paid to him in cash or should be transferred to his loan account. Now remember, the question mentions it directly and very clearly that whether the amount is to be paid or not. In this case, nothing was mentioned. And for that matter, if in case in any other question it is not mentioned that it is to be paid, you must transfer the total balance of the retiring partner to his loan account. So we'll close this account by transferring it to C's loan account, which would be 90,000, and it would total out. Now remember, while preparing new balance sheet, capital account of A will show a balance of 1,50,000, that is the closing balance. B would show a closing balance of 1,40,000, but there will be no capital account of C as he would have retired from the business by that time. Only a loan balance of 90,000 would appear on the liability side of the balance sheet. The balance sheet of the new firm, that is with continuing partners A and B, would appear like this. On the liability side, we will have creditors. Creditors will have an amount of 40,000 because they were revalued at 40,000. Now students, C's capital would now be transferred to C's loan account. So C's loan account has a balance of 90,000 which appears on the liability side. Then A's capital account and B's capital account. A's capital had a closing balance of 1,50,000 and B's capital had a closing balance of 1,40,000. Coming on to the asset side now. On the asset side, cash will continue to appear at 50,000 as there was no receipt or payment of cash. The next value was stock. Now the value of the stock was decreased by 30,000, so it will continue to appear at 20,000 only. Debtors, there was no change in the value, so it will appear at 1 lakh. And for land and building, there was increase in value of 50,000, so it will appear at 2,50,000. So the total comes to 2,50,000 plus 3,50,000 and total is 4,20,000. On the liability side, we have 2,90,000, 380, and that is 4,20,000. So students, the balance sheet tallies out. That means all the entries have been posted correctly, and this is the new balance sheet, that is the balance sheet of the remaining partners A and B after C's retirement.